Morning, everybody. It's December 18th today. Year's almost over. I will be, the Ardeni team, the Ardeni research team will be taking the rest of the year off. I'll probably still be writing some of these quick takes, so you might see that. And depending on how things develop, might do a unscheduled web chat. But for the most part, I think I'll leave you alone, let you enjoy your holidays with your friends and families, and I hope you have a great time with all, and a happy New Year, of course. The outlook for the economy is something that people usually do this time of year for the economy and financial markets. Kind of capped off the year with a piece on the 12 good reasons for being bullish or remaining bullish next year. So I'd like to go over that some more. Before I do that, let me tell you about the weather here, as I know you're all very interested in what's going on in Long Island weather. We had 50, 60 mile an hour winds last night. So a tree got blown over, and so that's the excitement in our neighborhood. We live on a kind of a cul-de-sac, and so a lot of us are trapped until the gardener comes and cuts the trees. But nobody got hurt, and everything's just fine. Max is here as usual. Bailey bailed out on us. Bailey was there as well. Max, hello, Max. Okay, I know some of you don't believe that Max is a real dog. I'll prove to you. Some of you are always wondering why he's always exactly in the same position and sleeping, but that's his favorite place to be between 11 and 11:30 Eastern Standard Time. So I don't know what it is about these conference calls that he likes, but he certainly gets some deep sleep during the experience. Well, things have not been terribly stormy in the stock market. They've been great. I guess with the benefit of hindsight, it turns out we weren't bullish enough. At the beginning of the year, we thought 4,600 on the S&P 500, and here we are moving towards 4,800. So that's really quite impressive performance by the market. Clearly, some of the recent move to the upside in the market is related to the Fed basically indicating that instead of 2 rate cuts next year, they're going to give us 3 rate cuts. And it seems that some Fed officials are surprised that the markets got that excited by what they basically announced in their summary of economic projections. But I think what the Fed has done and the FOMC has done is kind of cement the notion that the Fed is done raising interest rates, that the Fed funds rate is deep into restrictive territory, which, you know me, I'm an optimist and I'm a bull in this case, but I'm thinking about it and said, really? I mean, if we're that deep into restrictive territory, why is the economy doing so well? I think part of the answer is maybe the economy isn't as interest rate sensitive as it once was. I think that in some ways what the Fed has done isn't really just tightened. It's actually normalized. We're back to normal interest rates. It's kind of refreshing to have interest rates back up here, certainly for fixed income investors, and certainly for those of us who'd like the capital markets to have some say in how capital is allocated in our economy. And so having somewhat freer movements in fixed income securities is a good thing. I mean, when the Fed is targeting the Fed funds rate at 0, short and long-term interest rates are all kind of trapped near that level. However, when we get up to 4 or 5%, we can see that the bond market can have a mind of its own. For a while there, we got up to 5% of the 10-year. Now we're down just below 4%. So the market is working on doing some allocation of capital, and so far the credit markets remain wide open. The banking sector is doing reasonably well. I mean, we are seeing some slowdown in loan growth, but I think some of that's because the capital markets are open and borrowers are able to go into the capital markets for some of their needs. But I made a list of 12 reasons to be bullish for 2024. Let me just I wrote them down here so I didn't have to remember them. So let me just list them. Interest rates are back to normal, as I just said, which is a good thing. So why couldn't we have the bond yield stabilize 4 to 5%, maybe a little lower than that? I think 4 to 5% is a reasonable level. That's where we were before the great financial crisis. Consumers have purchasing power. There's been a lot of talk about consumers running out of excess savings, as though that's the only reason that consumers have been purchasing. But clearly, they have purchasing power because the labor market continues to create jobs, and wages are rising faster than prices. So that's all very important. And in addition to that, there's other sources of income that are all-time record highs, such as interest income, rental income, dividend income, proprietors income, all at all-time record highs. We've also made the point that that households are wealthy, and they are liquid, actually. So, when markets go down, the knee-jerk explanation is all liquidity is all dried up. And then when they go up, suddenly liquidities come back. The actual data show that households have a record $151 trillion in net worth. We've discussed this before. We've discussed that about half of that is held by baby boomers. So it's the Leonard Nimoy as Spock saying, live long and prosper. One of the reasons we have income and wealth inequality in our country is because the baby boomers are living long and prospering. The longer you live, the more that you buy some assets along the way, save along the way, the greater wealth you're going to accumulate. And so we've seen a tremendous increase in wealth in our country. Never had a wealthier household sector than now, record high, and never had a generation like the baby boomers who are as wealthy as they are. And a lot of that wealth, a fair amount of that wealth is actually sitting in liquid assets, which are yielding a pretty good return. But obviously there's interest rate risk in the sense that if interest rates come down, if the Fed's actually going to ease next year, then people start to get uncomfortable about sitting in deposits earning some interest and in money markets earning some interest. So there's a lot of firepower in the liquid markets that could still go back into the bond and stock markets. Demand for labor is strong. It's not as strong as it was, but it's really quite strong. Job openings remain very high. And some of that's related to the demographics that we alluded to. The baby boomers are retiring. They're going out to restaurants more. They're traveling more. They're seeing they're going to healthcare providers more often. And those are all services industries that are very labor intensive. And so we have a tremendous demand for labor in those sectors of the economy. And that likely will continue, even in construction, which is a very cyclical industry. If we were in a recession, you would see construction employment going down. Instead, it's at an all-time record high. And we know why that's happening, because while single-family housing starts have been weak, multifamily has been strong. And then there's infrastructure spending by the government, and there's onshoring, boosting non-residential construction. So all that means that construction employment is at an all-time record high. So that's the fifth item. Onshoring, the onshoring boom is boosting capital spending. We'll look at that chart in a minute. This is a layup. Housing is all set for a recovery. I mean, we're down from 8% to under 7% on mortgage rates. That's got to be a big booster to housing activity. So how do we have a recession next year if housing is actually recovering? And by the way, we also have had a rolling recession in the goods sector, and looks like latest retail sales numbers suggest that that may be starting to recover. Corporate cash flows at a record high. We've discussed that in the past. Corporations have lots of liquidity. They're generating lots of cash. There's people forget about this. The bears forget about the depreciation allowance. It's a great tax shelter, and it provides a tremendous amount of cash flow to corporations. Inflation is turning out to be transitory. I don't know if that's still controversial. I mean, I don't think anybody can dispute that it's turned out to be very transitory in the goods sector, and it's largely turned out to be related to the pandemic, the supply chain disruptions. So we went straight up in goods inflation, and now we're back down to zero. and some deflation in durable goods. So that turned out to be transitory. So we just need to have some patience here and wait for the services economy, which tends to be a little bit stickier, to show moderating inflation. We're starting to see a peak, obviously, in rent inflation, and that should continue. We're seeing some moderation in wage inflation, and that should have an impact on the labor-intensive areas of services in terms of the inflation rates there. We've talked about the high-tech revolution as boosting productivity. We'll just review a chart there in a minute. We've talked about leading indicators are mostly misleading. Again, we'll talk about that in a minute. The rest of the world's challenges should remain contained. I mean, honestly, who knows? I mean, is the situation between Israel and Gaza going to stay contained? Well, the Houthis don't want it to stay contained. It's we're having some issues with passage on the Red Sea because of the Houthis shooting off some cruise missiles and drones, and we know where they got them from. I just really don't understand why we don't threaten Iran and tell them to tell their subordinates in Yemen to cut it out. But anyways, that's an issue. And the Russian-Ukraine war so far has been contained, though. Who's kidding who? It's a proxy war between Russia and the West. But for all practical purposes, the violence has been contained to Russia and Ukraine. And finally, 12th reason for being bullish going into next year is the roaring 2020 scenario, which looks, I think, increasingly credible, increasingly possible. And I think the market started to discount that in November of last year when there was a lot of excitement about AI. The pessimist bears called it hype. I don't think that it is hype. I think there's a lot going on suggesting that that the markets are starting to realize that there are technologies out there that can be used by every business to increase their productivity. And that means that the bull market really just doesn't need to be focused on 8 stocks that are technology-driven stocks that produce technology, but it can be broadened out to companies that use technology to increase their productivity. So I think we're starting to see the bull market broaden out. I think the reason for that is the immediate reason for it is the perception that the Fed has done raising interest rates and the increasing credibility of the soft landing scenario, or at least the increasing belief that a recession is not very likely after all, after waiting for it in 2022, 2023. I think people are kind of not as concerned about it in 2024. Maybe from a contrarian perspective, we should worry about it. But anyways, let's look at some charts. Let's see, screen sharing stopped as the shared window is closed. Okay, let me go back to the charts here. Okay, let's run through the charts quickly. So the bears argument is plausible. The Fed has raised the Fed funds rate by over 500 basis points since March of last year. That's the fastest increase in the Fed funds rate since Volcker was around. You look at the history of monetary policy tightenings, which is kind of the gray shade shows you when the Fed funds rate has been rising. And guess what? In the past, monetary tightening has led to recessions. The recessions were basically engineered by the Fed to either bring price inflation down or to cool speculative excesses. And so tightening typically causes recessions. So far, that hasn't happened. It could happen. Not saying it's totally out of the realm of possibilities, but I don't think it's going to, it's very likely even in 2024. So the bears have been pointing out that the inverted yield curve has been quite accurate in predicting recessions, which it has been. I've been pointing out that what the yield curve really does is predict a process which leads to a recession. It predicts that if the Fed keeps raising interest rates, something will break in the financial system, we'll get a credit crunch, and that'll cause a recession. Well, something broke in the credit system. We had a few banks blow up in March. The Fed came in and contained that crisis quite well. And so you think we're going to get another banking crisis? Maybe there could be something related to commercial real estate, but the Fed's now leaning towards lowering interest rates, and credit conditions have actually eased off. And we certainly haven't seen credit spreads in the high yield market kind of blow off to the upside. So I think it's not going to work this time, but we'll see. Another indicator that the bears have pointed out to, of course, is leading indicators. They peaked a long time ago, December of 2021, but they're still in the realm of not being totally wrong. If we have a recession like in the next 3 to 6 months, which again I don't think is very likely. Meanwhile, the coincident indicators keep going higher and higher to record highs. And they'll probably do that in November. This is October data. So November, we know that payroll employment was strong. We know there was an uptick in production. These spammers, I don't know how these spammers call the landline and then within seconds call the my cell phone. Anyways, they're annoying. So let's go further here. How about M2? M2, inflation adjusted and in nominal terms, is negative on a year-over-year basis. It used to be pretty good leading indicator for real GDP, but the relationship has been sort of it hasn't been very good since. So the other thing to recognize is the reason we've got negative growth in nominal and real M2 is because of the year-over-year comparisons. We had this huge increase, and now we've got this decrease. And again, it's not an indicator that I think is going to work this time around. So what's the good news? The good news, as I mentioned, is the labor market seems to be really doing quite well. And you can see here that this is the latest data we have for job openings. The small business survey shows that 40%, that's the blue line, 40% of small businesses said that they still have job openings. That's still above where that series was before the pandemic. This is the JOLTS job openings in millions, and you can see that that's still very high. So yeah, things have tightened somewhat relative to the huge demand for labor here. Maybe there isn't as much demand, but it's still quite high, particularly in those areas where the baby boomers and seniors are spending a lot of money. And that, of course, is restaurants and hospitality, leisure, flying, and healthcare. So the consumers got purchasing power. Not only is employment increasing, but real wages are increasing. This is average hourly earnings that comes out with employment every month. And every month when it comes out, we divide it by inflation. So we use the deflator. And so the latest we have there, I think that should actually be October. This new chart program is great. Still got a few things we need to tweak. But at any rate, the trend, the upward trend is back intact after being stalled for a while. And that can only happen if productivity is increasing. Here we had all these quits and productivity was all over the place, going up, going down, got all messed up. But I think we're back on at least to the average growth in real wages consistent with average growth in productivity. But I think productivity is going to grow better than average in a roaring 2020 scenario. So well, you can look at this on your own. There's a lot going on here, but the basic message is that real wages and salaries, all-time record high, nominal wages and salaries, all-time record high, and the other income, which people often forget about, unearned personal income is interest, dividends, rental income, and proprietary income, all-time record high in nominal terms, and starting to move into record high territory in real terms. Household net worth, as I mentioned, is $151 trillion, all-time record high. Look how much of that has occurred just since the pandemic. And it's been a fairly broad-based increase in assets. So it's not all assets that are owned by the ultra-rich. There's real estate in here. There's pension fund reserves. There's owner's equity. And again, that's not just the rich that own real estate. Debt securities, life insurance reserves, all of them at or near record highs. Money market mutual funds, you can look at that as this is bearish for the market because there is an alternative. Tina is not relevant. There is an alternative to stocks, and that's money market funds. The problem is they're tied to short-term rates, and if people start to perceive that short-term rates are coming down, that money can leave. And where might it go? It might go into the bond and stock markets. Deposits, yeah, they're down. This is M2. Yes, you can see that. Oh my God, M2 is taking a dive here, but it really is just going back to trend, and it actually looks like it's starting to stabilize around trend. Deposits are the biggest component. This is weekly data on commercial bank deposits. The Fed stopped publishing M2 on a weekly basis, so we figured out that we could get a pretty good handle on it by watching weekly deposits at all commercial banks. And you can see that that too is sort of leveling out. But that's $17 trillion. And to keep deposits from flowing out, banks have had to be paying higher deposit rates. And if those things are going to start coming down with the Fed easing next year, that'll mean, again, more cash possibly going into longer term, longer duration kind of securities. I mentioned that with all this purchase power and all this wealth and retiring baby boomers, some industries are absolutely booming, and you can see that in the food industry, food services, and drinking places, all-time record high. People are still obviously eating at home, but what's the point of cooking at home if it's just the two of you? Your seniors, the adult the adult children are gone. So might as well start splurging and enjoy it. Why leave it to the kids, since they never listened to you and they never cleaned up their room and you didn't like their friends? So the more you can spend, the less you have to leave them. But I think there's so much money that the baby boomers have that they're not going to be able to spend it all. And I think a lot of the kids of the baby boomers are in fact anticipating that they are going to get some sort of inheritance, and that might actually reduce their savings rate and mean that they will consume more. I think we're in a decade where the savings rate is going to remain fairly low. So consumers will spend their purchasing power. They won't save as much. Meanwhile, the onshoring, we're seeing factory construction is booming, and you got to fill the factories with machinery. You got to build them with machinery. So this is construction machinery, new orders, not all-time record high, but excluding this volatile area, they're doing very well. This chart we've looked at before. This is construction of manufacturing facilities in real GDP and in nominal terms, and clearly this thing is absolutely booming. Inflation is turning out to be transitory. It's not turning out to be the 1970s all over again. It could be. I mean, if the war becomes regional in the Middle East, Iran gets involved either because somebody bombs our oil facilities or because they block the Straits of Hormuz or whatever complications involved there, then we could have another surge in oil prices, and that would undoubtedly have widespread inflationary repercussions to other prices. So we could have a kind of a twin peak scenario. And certainly in that scenario, with oil not being available and the price going 100 and plus, we'd have a recession. But that's not our scenario. We think the regional wars remain contained. We're unfortunately learning to live with the Ukraine-Russian situation. The Europeans have learned how to get gas from other sources. They're not dependent on Russia anymore. So this is turning out to be a transitory spike in goods inflation. Part of that is because supply chains have loosened up. This is the supply chain index that the FRB New York puts together. And as you can see, that's come down dramatically. The New York Fed just came out with their November survey, and they have a series that's also sort of a supply chain related kind of delivery times, I think it is. And that actually took a dive in November. So the goods sector is not having any supply chain issues whatsoever. Nor is the goods sector having a problem with transportation. It's not hard to get trucks. It's not hard to get goods delivered through the LA to the Los Angeles and through the California West Coast ports. And so here is the PPI transportation and warehousing, and you can see that it was deflating during the pandemic, soared here into double digits, and now it's deflating again. And everybody got totally bent out of shape about how transportation costs were going to cause prices of everything to go up, which they did for a short period of time, but now we're going the other way. So here's the productivity story. We've talked about this many times. We use the 20-quarter annualized change in productivity growth. And there was a productivity boom in the 50s, 60s, mini one in the Reagan years, another one in the 90s. And now I think we're starting on a new one. Got a little bit disturbed here by the pandemic, but we were at 0.5 here. We're at 1.8. I think we're going to 3.5%, 4.5%, which is consistent with previous peaks. And all that happens between now and the end of the decade. So by the end of the decade, I think the 5-year trailing productivity annualized number will be something like 4.5 to 3.5 to 4.5%. Another area where the economy is likely to continue to do quite well is in defense. And you can see this is industrial production of defense and space equipment. And so, just with this, with housing making a recovery, with the onshoring, it's all obviously going to depend on the consumer. And the consumers right now look like they got jobs, they got real incomes, and they got wealth, and some of them are retiring and spending. So all in all, I hope this gives you something to kind of organize your thoughts about what could go right in 2024. I will spend some time at the beginning of next year reviewing all this and reassessing what could go wrong. But again, wanted to put you in a good mood just in time for the holidays. So let's see if we get some questions here. I think we do. So, John, small cap stocks performance has struggled compared to large caps since 2018. As you pointed out, what are the reasons you think this relative performance may improve finally in 2024? Finally is the right word. I mean, some of us have been observing for too long that the SMID caps are real cheap relative to the large caps. I put out a quick takes last night exactly on that subject, looked at the equal weight over the market weight S&P 500, and it looks like it's broken out to the upside. The ratio is broken out to the upside. The bottom was made on November 13th. We also are seeing the S&P 600, 400, and the Russell 2000 all outperforming the S&P 500. So we're seeing a broadening of the S&P 500 within that index. We're seeing a broadening of the rally to the SMID caps. And it could be a head fake. We've had them before where they look like finally they're going to outperform. But I think benefit of hindsight, small caps, SMID caps were held down by this ongoing fear that, we don't know how high the Fed's going to have to take interest rates to bring inflation down. We don't know how high bond yields are going to go. We don't know if that's going to cause a recession. Certainly seems like it should cause a recession. And there's a lot of smart people on Wall Street and Main Street saying we're going to go into recession. So let's just buy large cap, good balance sheets that can make it through this kind of environment. And all that money went into, call them the Magnificent Seven. I call them the Mega Cap 8, including Netflix, because I watch a lot of Netflix and I review a lot of movies. But so what's different this time? Well, I think finally, what's really finally seems to be the consensus view is that the Fed's done raising rates. That's a pretty big deal. And it's done raising interest rates just when the economy looks like it's doing reasonably well. In the past, the Fed would stop raising interest rates when it looked like the economy was going to get trashed, was going to go into recession, and the Fed would reverse course and lower interest rates dramatically. And that would be bullish, but there was always that lingering concern that, well, maybe interest rates aren't going to work this time because the economy's falling apart so quick. This time around, the Fed's done. The economy's proven to be resilient. And now, the only question is in the markets how much will the Fed cut next year? I think 2 to 3. The people who are looking for recessions are probably talking 4 or more. But I think that's really what's changed for the markets. Also, the less angst about a recession. With housing likely to be improving, and with some of the other sectors showing, like defense, showing strength, onshoring, and so on, and the consumer likely to remain resilient for all the reasons we've discussed, I think the SMID caps are doing well, and they are certainly cheap even now. Okay, thank you, John. Doak, Merry Christmas. How does the presidential election factor into your 2024 thoughts? Thank you. I try not to think too much about the presidential elections. If it's Biden versus Trump, shoot me now. Be kind of nice if the old baby boomers, the old geezers would just kind of get out of the way, work from home, check into a nursing home, just do whatever. But looks like that's looks like the way it's going right now. Things can change clearly in terms of who's running, but honestly, I wasn't kidding when I said I'm trying not to think about it too much, because the problem with all these political developments is you never know until you know. A lot of things can happen, so we'll have to see how it plays out. But my fallback has always been, for those who get all pessimistic about the partisanship and the politics in our country, my fallback has always been, don't forget about us, you, me, and everybody else that are working stiffs, that are working hard every day to make life better for ourselves, our family, our kids, our communities, our country. And we do a pretty good job of it. And we do that factoring in our business planning and our strategizing about what we're going to do today. We do factor in what the politicians are doing to get in our way. And so the bottom line is, the country's done remarkably well despite Washington, whether we're talking about the Fed or the Treasury or Congress or the White House. We've done remarkably well. We're likely to continue to do really well. So let's just keep doing what we're doing. Live long and prosper. Spock was absolutely right about that one. Okay. Jake, the Fed is expected to cut rates throughout the upcoming years. When they are done cutting, should we expect a major stock market drawdown like it has been the case almost every single time in the past rate hike cycle? And perhaps more importantly, why something about the SPY and the Fed funds rate? Look, right now, let's end the year on a bullish note. Let's not worry about all the things that go wrong. There's a whole bunch of pessimists that are doing that for us. Let's follow them and then try to provide some balance of what they could be wrong about. But for now, I'm shooting for 5,400 on the S&P 500 at the end of next year, and 6,000 at the end of 2025 on better than expected earning because of better than expected growth with driven by productivity. That's a scenario for kind of a long bull market. I know that we've all been discussing whether this is the 1970s or the 1920s all over again. There are other analogies. The 1990s was the beginning of the technology revolution. And in many ways, this is the kind of second phase or third or fourth phase of the technology revolution. Technology has never been cheaper, more useful, easier to use, and more applicable to more businesses than ever before. And so at this point, let's talk roaring 2020s as the base case when we're thinking about where things are going from here. But at some point, we'll have a bear market again, and I'll probably miss the top and get the bottom. I've turned out to be pretty good at calling bottoms. I'm still working on tops. Okay, Brian. Dr. Ed, thanks for the great work as always. I was surprised by a client question last week, which I will pose to you. It's ample. I'll take this as the last question. It's an ample question, but it caught me off guard because he was adamant. Since supply chains have healed, is the inflation we're seeing due to greed? We all know it isn't that simple, but the client had a decent point. Supply chains are better than they were. No, it's not. Look, people are confusing the price level with inflation. Inflation is definitely slowing down. The price level isn't going to suddenly go down to where it was 2-3 years ago, because wages have also gone down. There's a sort of money illusion out there, in that people think that when they go to the grocery store, my God, look at how everything has gone up in price by 50% or maybe even doubled, and they forget that for the most part, when you look at the aggregate wages and prices, it's been real wages have gone sideways. They haven't actually gone down, and now real wages are going up again. Yeah, I mean, I go through the same shock when I, go to restaurants and sometimes see what the bills are. But I think the rate of inflation has come down. I don't know that we're going to have outright deflation that brings prices back down. Well, we had let me see, I'll do one more. How do you interpret the difference in messaging by the Fed, specifically Powell versus Williams? They kind of screwed that up, I thought. It's I love the Fed. They provide a lot of content. They provide me with a lot of reasons to write and try to give you my views on things. But yeah, Powell sounded very dovish, basically getting excited about the possibility that we are going to have this soft landing after all without a recession, and that inflation could continue to come down. But I think it was the summary of economic projections that really got everybody bulled up. It's instead of 2 rate cuts, suddenly they're talking about 3 rate cuts. And I thought it was kind of bizarre that he explained exactly how they put the SEP together. They just go around the table and everybody says, here's mine, here's mine, here's mine. And there's no discussion, there's no attempt to influence each other, which is really bad messaging, because if you're going to just kind of randomly put together everybody's opinions without thinking about, well, how might this impact the markets if we go from 2 to 3 rate cuts? Might they get too overjoyed? Is that the message we want to get across? Well, apparently not, because all of a sudden the other Fed officials are saying, well, not so fast. We're not really talking about interest rate cuts, and we don't know when we're going to do them or how many we're going to do of them. So I think the messaging has been pretty sloppy. But I think the main message it's getting across is the Fed's done raising interest rates. And the consensus has been that there's going to be 4 rate cuts. I'm going to play the contrarian here and say 2 rate cuts. The real contrary would be, the Fed's going to have to raise interest rates again, but that's not where my head's at. So let's root for the roaring 2020s. I hope some of you have a chance to go to New Year's parties that have that theme, and let's hope that doesn't jinx it. And have a great Christmas. Hope you had a great Hanukkah. And I hope you have a great New Year. But you know me, I'll probably be in touch before year end. But at least my teams getting some rest. This is what I enjoy doing for a living. So this has almost become kind of a hobby for me, especially now that I got this new chart program to play with. So all the best to all of you, and let's have a good year.